Hi, this is PR Sundar. Welcome to this special episode where I'm going to talk about how one of my friends has lost a huge sum of money. This is hopefully a lesson for retail people, right? Now, in our markets, the people buy the shares, so if the share prices goes higher, so they must be happy, right? So I bought the shares, prices are going higher, must be happy. Now, as per some study, the people say retail people know when to enter, but do not know when to exit. So many people, if they don't find value, they don't buy. Say, for example, some stocks like PFC, REC, BSC, so many stocks we discussed about 3-4 years before. That time they were offering very high value, like, dividend yield was 10%. The dividend yield was better than bank FD return. And then, they were all PSU companies, so they're doing very well, right? Now, what has happened? Some people bought it. I always say, when you buy, you don't buy at one go. Don't go and invest all the lump sum money. Lump sum money you can consider investing, as and when the markets are very, very bearish like this. And then if you have the appetite, the markets can fall even further. But otherwise, over a period of time, you invest some equal amounts. So what the people call it as SIP, Systematic Investment Plan. But somehow I feel that the word SIP is overrated and the word SWP is underrated. So just like SIP, there is something called SWP, Systematic Withdrawal Plan. Right? Say, if you have bought a stock, so let us say it has appreciated by 100%, right? Why not book some small profits? Maybe, 20%. Like, let us say another 100% it goes. So nothing wrong if you book another 20%. So at least, when the price goes like 3 times, 4 times, 5 times, at least you book, overall, at least 50% of the profit. That means you will get back the money more than what you have invested. So whatever the remaining shares you are having, that will be absolutely free of cost for you. Then after that, no matter how much it falls, so nothing is going to happen. So you are not going to lose anything. So, but people, as prices goes higher and higher, they expect the markets to go even higher. When Nifty went to 26,000, so I told one of my friends, the market seems to be a little bit overheated. He says, sir, ये तो सिर्फ ट्रेलर है, main picture अभी बाकी है. Now I'll tell you, Nifty will come to 30,000. So only when Nifty goes to 26,000, people get the confidence that it will go to 30,000. Second thing, this is not for small people, for the big people, it always makes sense to do some kind of a hedging. So if you can remember, like few months before, I bought, when the Nifty was at 24,000, I bought Nifty Beats. Now it has come to 23,000, 1,000 rupees loss, right? But I don't care. You know why? Because, and I bought a 24,000 put option. I paid only 2% of my capital. So I just paid 2%, extra money. I bought the 24,000 put option expiring in December 2025, right? So now no matter market falls, I have nothing to lose. The maximum loss I will have is only 2% of my capital. So that 2% of my capital also, I'll be taking it through some other means, like, the people, what is covered call and those kind of things. So they are very complicated things to discuss here. So which means that, I bought Nifty Bees at 24,000, again bought at 23,500. But my situation is like this. Either I will gain or I will not lose anything. So absolutely, there will be no loss. So accordingly, I have done the hedging. Either people don't do hedging or people don't do partial profit booking. Okay, both are fine, right? But there are some people, what they have done? That is what exactly one of my friends has done. And he got some information that this particular company is doing well. and that, the prospects for this company is really very good. So in future, the market's likely to go higher. So he bought a lot of shares. So as expected, so the price started moving higher. So I think he bought the share for about 500 rupees and it has gone to 1200 rupees. So more than double, right? So if I had been in his place, I would have half the shares I would have sold it so that the remaining half the share will become free for me, right? Or even if I am not sold the shares, I would have done the hedging. But what he has done, he became more greedy and he thought markets will continue to move higher. So what he has done, right? He pledged the shares with a bank and took a bank loan and use that money to buy more shares. Some people, they don't go to bank to raise the loan. What they do, if they have 1 lakh rupees, okay, they borrow 4 lakh rupees from the broker, right? Then they buy the shares for 5 lakh rupees. So what they call it as a margin trade funding, right? So this margin trade funding, I think as per one estimate, now it is about 80,000 crores. So as a retail people, you should ask one simple question, right? I am a retail guy. I am a very small guy. I have only 1 lakh rupees, right? Then I want to borrow 4 lakh rupees from my broker, okay, to buy the shares for 5 lakh rupees. Now, if the share return is really almost sure that, we are going to get more. Of course, the brokers will be charging interest. They'll be charging anywhere from 9% to 12% interest, right? So that means the share price has to go higher, right? More than that interest. So otherwise I will be losing. But no, you tell me you are rich or your broker is rich. You are knowledgeable or your broker is knowledgeable, right? You have more contacts or your broker has more contacts. Then if there is a possibility of making money, the broker himself will be buying the shares, right? Why should he lend the money to you for the rate 9% or 12% rate of interest, right? And here, who is a smart guy? And then what happens, when the market falls, even if the price falls 20%, right? Your entire capital is being wiped out. The broker will ask you to pump in more money or the broker will start squaring up your positions. So that is what in stock market they call it as a margin call, right? So probably a lot of margin calls are happening in many mid cap and small cap companies. The stocks, if 100 rupees stock has gone to 500 rupees, I'll just give you one example. Bharat Heavy Electricals, right? It was trading around 80 rupees. It went up to 320 rupees. Now it has come to 200 rupees. After falling 50% also, now I look at it is trading at 135 P ratio. Now the people say, no, sir, they have a land bank this, okay, they have a land bank this and that. Then why the hell it was trading around 80 rupees 1 year before? The point here is that, people buy more shares, okay, by taking a loan, right? So that's what my friend has done. Not only that, and he has become too bullish. So what he has done, he has taken the loan and put the money, right? Bought more shares. Okay, that more shares he pledged with the broker, he got the limit, okay, and then he started selling options, put options, because he was very bullish. And then what happened? By selling the put option, you receive the premium. And many people, right, not so well knowledgeable people, okay, they think that the money come to their account, it's their profit. You sell an option for 1 lakh rupees, that 1 lakh rupees will be coming into your account. That is not your profit actually. That's a premium you collected. So then tomorrow you may have to return that premium. You may have to return even more than what you collected. But what has happened, how much premium you are collecting, margin plus this premium will also be added into the margin. But the thing is that margin can be adjusted against the collateral. So the cash will be lying in your account. So what my friend has done, use this cash to buy more shares. He bought the shares, prices went up, right? So when the prices went up, what happened? His collateral limit also increased. assume that he bought a shares for 50 lakh rupees. That shares value has gone to 1.2 crore. Now he placed the shares for 1.2 crore, he get the limit of 1 crore. So he used that 1 crore limit to sell options. He collected premium, like 20 lakh, 25 lakh premium came, right? But that premium also he started buying the shares. So now what has happened? Prices started correcting and every day 3%, 4% fall in the prices. So when the price falls, what will happen? Number one, whatever money that he invested, so that money is getting lost. Of course, that is not a big thing because he bought for 500 rupees, that went up to 1200. Now coming to 1100, 1000 rupees, he has nothing to lose. But what has happened, by using the option premium, he bought some more shares at 1200. So when the prices start falling, the shares that he bought at the higher level is giving him the loss. That's number one. Number two, he bought the share for 50 lakhs, but that went up to 1.2 crore. So because of that, he got 1.2 crore limit for trading, right? And now there is also some loss, okay? Not only the loss, the margin money. When your share value come down from 1.2 crore to 1.1 crore, your trading limit will also be reduced. So that means 20 lakhs worth of position you have to close immediately. But since he was bullish, he sold only put option. They were in losses, so he has to sell those. He has to book the losses in futures and options also. So every day he used to get a call from broker, as a margin shortfall. Either you pump in more money, or we may have to close the position in F and also. We have to sell some shares also. So every day, my friend has been selling the shares in the market, right? So that's because, one thing, he bought the shares, and second thing, in the market went higher, he bought more shares, by taking the loan. And when the market went even higher, okay, he placed the shares and then started trading in options for the full value. So your money is only 50 lakhs. You should have taken position only for 50 lakhs in F&O. Then he would not have got into trouble. But because the limit is 1.2 crore, he traded for 1.2 crore. So now when the stock market is showing, I always say retail people, they are really very good people. Right? And you tell me, you must be knowing many people who are trading into the stock market. How many people short the market? As far as I know, 95% of the people, they go long in the market. So they don't go short in the market. Right? Only the professional traders, they go short in the market. Right? And option buyers is different. When they expect market to fall, they buy put option. When the market expect to go up, they buy a call option. But I'm talking about the sellers or, cash market, futures and options traders, with a big capital. So what happens, the problem with the retail people, so they are long in the cash market. So actually, the smart people, what they do, if they are long in the cash market, use that collateral, they only short in the futures and options market, so that it balances out. So in case market goes higher, your cash market will do well. When the market goes down, your thing will do well. So what they call it as a pair trading. Say for example, you think that Axis Bank is a good bank, or Kotak Bank is a good bank. Buy the shares, right, for about 10 lakh rupees. For the same 10 lakh rupees, you short Bank Nifty future. So what happens, if the market goes higher, definitely that, because this Axis Bank or Kotak, this example I'm giving, so this will outperform the Bank Nifty. But in case if market goes down, you will get some profit in a Bank Nifty future. Then, every month, cash market you buy, there is no rollover. But future, when you short, at the end of the month, when you roll over also, you will get some premium. I think Bank Nifty, you get 400, 500 point premium, right? That alone will give you about 5,000, 6,000 points, right? So it's basically, it's a balance, long and short, right? But most of the retail people are really nice people. They are always optimistic people about India. So they always, cash market also they go long, in futures and options market also they go long. When the market falls, they lose money in futures and options market, their collateral value will also go down. So because of that, the margin calls come very, very quickly. So this is how many people have lost a huge sum of money. So my advice to you, keep your portfolio separately. Cash market portfolio is different and futures and options folio is different. The cash market folio, you want to pledge it, you can pledge it, but use that capital only for hedging your portfolio, right? So in India, still people do not realize, the importance of hedging. I know many people, middle class people, they never take insurance. Suppose a neighboring apartment, the one guy dies by accident, then only they will raise, however, this happens to me, what will happen to my family? I should take insurance. No, but he will be thinking for a few days. After a few days, he will forget, he will never take insurance. So the people don't realize the importance of insurance. So the same way in stock market also, people don't realize the importance of hedging. Right? So especially if you have a large folio, so it's compulsory that it's good that you always hedge your portfolio. See, I bought some Nifty Beats at 24,000. Now come to 22,800, 1,200 point has fallen. I don't get any stress because I have the hedge. For those who understand, I can tell you, I bought Nifty Beats when it was trading around 24,000. I bought 24,000 put option expiring in December. Right? So whatever the premium I had to pay, the same premium I collected by selling 28,000 call option. Right? Now, when the market is going lower, so my value goes down. But I don't have to worry because my 24,000 put option buy option is there. That's going to save me no matter. Even if Nifty goes to zero, I'm not going to lose even 1 rupee. And whatever the loss is in the portfolio, the same amount of money will be, profit will be coming from my buy option. Of course, that buy option, I did not pay from my pocket. I financed it by selling 28,000 call option. Now that price will also be going down, going to zero. Just the message that I want to drive in this episode, okay, if you have a folio, right, when the markets are euphoric, when the markets are running, when you are sitting with a good profit, consider some small profit booking. Like every time, when the market falls, people come and say, no, don't lose the faith. No, you look at this history, look at that history. No, market will definitely recover. You don't stop your SIP, continue your SIP. This is what most of the financial influencers are talking. But when the market is going to 25,000, 26,000, does anybody say, see, market anytime can correct. You look at the history, so many times market corrected, right? So therefore consider booking some profits, right? No, nobody tell you. So nobody talk about systematic withdrawal plan, but I spoke about systematic withdrawal plan many times in my videos. If you are a smart guy, so when the markets are in good shape, you consider booking some profits and do the hedging properly so that, no matter how much market falls, you will have no stress, right? Of course, you have to pay some premium, you want to get insurance, right? So if something happens to you, the insurance company will take care of your family, right? But of course, you have to pay some insurance, right? But that insurance is worth paying, right? The good thing about stock market, you don't have to pay from your pocket. You can finance it by selling a call option. So that's why the stock market is very, very interesting thing. So we discuss a lot of these things in our workshop. So now it is almost the middle of February. I'm coming to India in the first week of March. So I have one workshop in BENGALURU, right? Earlier I used to do a lot of workshops in Delhi, Mumbai, all the places. But nowadays, since I spend most of the time in Dubai, I don't have time. So I just do only in Chennai and BENGALURU, right? Maybe in future I may plan. Definitely, Mumbai is a financial capital. Anytime I do workshop in Mumbai, I always get full house, right? Maybe June or July, I might plan one workshop in Mumbai. And meanwhile, I am also planning some online workshop, right? So there we discuss all these things, how to do the hedging, and many of the things I have already given in free. videos, right? So it's not that I discuss everything only in workshop. A lot of things I've given free here also. Hope you enjoyed this video, and make sure that do not stop your SIP when the market is falling. Okay, do your SWP when the markets are rising, and do hedge your portfolio. Okay, and don't use leverage beyond a certain extent, right? Your leverage portfolio, keep it separately. Don't put the shares as a pledging, right? Even I am a trader. I trade in futures and options. But 95% of my capital, I keep it in debt funds only. And because, when the market crashes, my portfolio value will not go down because I have a lot of money in debt funds. So their value will not go down. So because of that, I will not run into, my problem is only the futures and options. But the people who pledge the shares and do futures and options, they have two problems. The problem in F&O and the problem in decrease in the tradable value, right? Margin. So both will be a problem. It's a double whammy. So it's very, very difficult because I experienced all these things in the initial period of my life, my trading life. So that's why I learned. So if you are really a trader in F&O, then better go for debt funds. Don't go for the equity funds. And equity funds, keep it only for hedging purpose, right? Or you take a counter position. Means like if you are long in equity, can take short in F&O. So nothing will happen. When the market goes down, what will happen? Your portfolio value will go down, right? Your margin will go down, but the MTM profit in futures and options will take care of that one, right? So it will balance out, right? Otherwise, if you are too good, you think everything positive, then you will become negative. So that is the issue there. So hope you enjoyed watching this video. Thank you for watching.